All right, let's get right into it. Today, we're not just talking about trading in bits and pieces. Nope, we are building a complete trading strategy from the ground up. We're going to move past all the guesswork and random clicking to build a logical, repeatable plan that's based on the one thing that truly actually drives the market. You ready? Let's do this. Look, this quote right here, this is our goal. This is our North Star. The whole point isn't to get lucky every once in a while. It's to build a real skill. It's about shifting your entire mindset from, gambling on price movements to making educated, high probability predictions. Everything we're about to cover is built on this one idea. And here's the roadmap for how we're going to get there. First, we'll uncover what really fuels the market. Then, we'll learn to read the charts. After that, we'll pinpoint exactly where our targets are, put it all together in a simple 4-step plan, and then wrap up with the one thing that holds it all together: discipline. Okay, first up, the market's real fuel. I'm not kidding. We're about to pull back the curtain on the one concept that, once you really get it, is going to completely change how you see every single chart from now on. So, let's start with the big, obvious question. Why do so many people struggle with this? Why do they lose? Is it just impossible? Not at all. It's because most traders are basically playing checkers while the market is playing a game of 3D chess. They see a simple tug of war between buyers and sellers, but behind the scenes, something much, much bigger is going on. And that something is liquidity. Seriously, burn this word into your brain. Think of it as the market's gasoline. It's made up of these huge pools of orders. You've got stop losses from people already in a trade and entry orders from people waiting to get in. Price doesn't just wander around aimlessly. It is literally engineered to hunt for these pools. The big takeaway is this: the market moves from one pool of liquidity to the next. That's the real game. Okay, so if the market is always on the hunt for liquidity, how in the world do we actually see it? Well, first things first, we have to learn the basic language of the charts. Let's break down the essentials. So, check this out. This is a bullish or an up candle. It's actually super simple. The main solid part, the body, that just shows you where price opened and where it closed for that time period. And those little thin lines, the wicks, they show you the absolute highest and lowest points the price hit. That's it. 4 key pieces of info in one simple shape. And this is just the opposite, a bearish or down candle. Same idea, just flipped. Price opened up here and it closed down here. The wicks, they still show the highest and lowest points it reached. These little candlesticks, they're the alphabet of the market's language. Now, this is where it gets really interesting. You have to see the market as this giant 24-hour machine, but with different teams of mechanics showing up for their shift. You've got the Asia session, then London comes online, then New York. Each session brings in a massive wave of new money that often looks to manipulate the moves from the session before. And why? To grab liquidity, of course. All right, we know what liquidity is, we get the basics of reading the charts. Now, for the really important part, where do we actually find the biggest, most significant pools of it? This is where we start identifying our targets. First up, we've got the session highs and lows. Think about it. The Asia session happens, and it leaves behind a clear high and low point. These become magnets for the London traders. They'll often push the price just below that Asia low, grabbing all the stop losses sitting there before maybe reversing price higher. And then what happens? The New York traders come in and often pull the exact same stunt on London's highs and lows. It's a daily rhythm of manipulation. Okay, zooming out a bit, we have the previous day's high and low. These are massive. I mean, they represent the extreme points of a full 24-hour trading cycle. So many orders build up above these highs and below these lows that the market is just drawn to them. They're like giant magnets for price. Now, this concept right here is an absolute game changer. You know when you see a really clean, obvious trend? What you are actually looking at is a perfectly stacked staircase of highs or lows. We call this low resistance liquidity. It's like the market has set up a row of dominoes, and it's just waiting to knock them all down. And this analogy just nails it perfectly. This is that aha moment. Imagine you're a big institution trying to fill a massive order. Why on earth would you just take out one of those little lows when there's another cookie right below it and another one below that? No way. You'd want to smash through and grab the whole jar. That's why trends often end with a sudden, sharp move that just wipes the slate clean. So, let's recap. We know what liquidity is, we know how to see it on the charts, and we know the key places to find it. Now it's time to put all of these pieces together. Let's build an actual, actionable 4-step plan. This is where the theory becomes practice. Here they are, just 4 simple steps: the sweep, the confirmation, the continuation, and the exit. This is our entire sequence, guiding us from spotting an opportunity all the way to cashing out. Let's break down exactly what each one means. Step 1 is the trigger. This is what we're patiently waiting for. We're watching for the market to make an aggressive move and attack one of those key liquidity pools we've already marked on our chart, like a previous day's low. That move, that sweep, is the event. It signals that a ton of orders just got triggered, which creates the potential for a major reversal. But potential isn't enough, right? We need proof. So after the sweep, we need to see the market confirm it. We look for something called a break of structure. Now that sounds technical, but it's simple. It just means the market shows us its hand. It creates a new high in what was a downtrend, for example. This little shift confirms that the sweep wasn't just random noise. It was a real move that has shifted the market's immediate direction. All right, now for our entry. And listen, this is so important. We do not chase the market. We are patient. We wait for the price to pull back, to come to us, to retrace into a logical zone. This could be the halfway point, the equilibrium of that confirmation move, or maybe an inefficient little gap in price that was left behind. This is our spot. This is the high probability zone where we can get in with a great price and a clearly defined risk. And finally, step 4, the exit. Where do we take our profit? Well, the answer is beautifully simple and logical. We target another pool of liquidity. If we took a short trade after a major high was swept, our target is now a major low on the other side of the chart. We're literally just trading from one liquidity pool to the next. That's the whole trade from start to finish. Okay, you have the concepts. You have the 4-step plan. But I have to be completely honest with you. Even the most perfect strategy in the world is completely useless without this final, and I'd say most important piece of the puzzle. We hear all this stuff about trading psychology, and it sounds so complicated and mysterious, but this quote just cuts right through all that noise. Psychology isn't some complex emotional beast you have to tame. It's just discipline. It is the simple, boring, non-negotiable discipline to follow your plan and stick to your rules every single time. No exceptions. And this really brings us to the final choice every single trader has to make. There's the gambler's mindset. They're trying to get rich quick, so they trade way too much and risk way too much. Then there's the professional's mindset. They focus on executing their skill perfectly. They wait patiently for only the absolute best A-plus setups, and they use the same risk on every single trade. One path leads to constant frustration, the other leads to consistency. So here it is. You have the entire blueprint, a strategy that's built on the actual mechanics of how the market really moves. But a blueprint is just a piece of paper. The real question, the one you have to ask yourself right now, is this. You have the strategy. Do you have the discipline to actually execute it?